the regulators said that they would guarantee all the deposits of SVB and also of other banks who need it. SVB actually has been marketing this. They are advertising this, saying that give us your deposits. This is the safest place in the world to be because all our deposits are guaranteed. I mean, I'm not making this up. They're actually marketing.
The cheek. Imagine the cheek of it. Devina Mehra, great to have you on the show. Let me begin by asking you to very simply explain why all of a sudden there are concerns over such big names in global banking and the whole global banking system. Is there something fishy going on?
Thanks, Tamanna. As you said in the introduction, banking is a confidence game, and this is something my mother explained to me when I was in school. That we all put money in banks and they're supposed to give it back when we ask for it. But in reality, no bank in the world can give back money if all or even most of its depositors come back asking for the money, because that money has been deployed somewhere and is not sitting in cash in the vault to be given back to you anytime you ask for it. So that is why even the most solid bank in the world, if there is a crisis of confidence, it can go bust, which is why regulators move so fast, because they do not want people to be worried and panicked. And I'm sure we should not be spreading that worry and panic. And as far as, if you go back to the Silicon Valley Bank, that had a few peculiarities, because normally we think of banking crisis as arriving, starting from bad lending, that you lent money in the wrong place, it was not repaid, what we all talk of as non-performing assets in the Indian context. And when we think banking crisis arises out of that. But in the case of SVB, for instance, it arose because they did not lend out enough, and they put all the money in securities which were supposedly safe, or at least not very risky, but they were very long tenor securities, because at that time when they were investing, interest rates were close to zero. So in order to get any return at all, they had to invest in securities which were very long dated, and then they were not as liquid as treasuries either, and they could not, as the interest rates rose, and they rose very fast, like the Fed has raised rates by 4.5% in less than a year. Last time that happened was in 1980-81, which is even before SVB was formed. So that is why, crises recur in markets, because people forget history, people forget risk control. If you read about SVB, as with many other managements, the focus was on quarterly earnings and they forgot about the risks. As far as Credit Suisse is concerned,
right? I was just going to come to that, Devina. SVB's story is a very different story from Credit Suisse. You could say SVB, Silicon Valley Bank, funding startups, high flying, maybe forgot the basics. But Credit Suisse, that's an institution.
Yeah, but Credit Suisse, I mean, I tweeted this a few days ago. It was a flippant tweet, but there's a grain of truth in it, that there has not been a financial crisis in the last several decades where Credit Suisse has not been part of it. So, they are you can say a repeat offenders. They have been last 30 years, there have been multiple scandals. You mentioned some money laundering, breaking sanctions. They have been stashing losses in client books. You spoke of spying. So they have been just in multiple problems through the years. So it's not as if it was considered a very, very good kosher bank and suddenly this happened. No, I mean, they have been a repeat offender and they've been there in practically every scandal to come out of the financial markets. So for people in financial markets, it is not so, not such a surprise that Credit Suisse is in the middle of a mess. And of course, now it is the bank itself, in a sense, is history, because it is merged with UBS. Of course, there are other collateral things, like there were these tier 1 bonds, and you would normally think that whatever it is, unsecured bonds, but they should be one notch above equity, but they have been written off completely, even if equity has not been written off completely. So equity holders might be getting a very, very small fraction of what they were worth even a week ago, but they're getting something, whereas the 81 bond holders are not getting anything, which might affect that market. But the regulators move fast and they have to move fast to prevent contagion. As of now, it looks that that contagion has been contained. And part of the reason is that this crisis is not driven, unlike the 2008-9, by poor credit, or that there is
Right.
that is the core point.
So yeah, so unlike 2008, it's not like the banks have lent to people who can't pay back. And I'm going to put this very, very simply, is that they have invested in places where the returns haven't worked out well in time, and it's sort of spread all over the place. So we have stricter supervision, more conservative banking. Devina, would you say that in these cases, both with Credit Suisse and, some of it will follow with Silicon Valley Bank, the way these banks are managed and the creme de la creme of managers sitting at the top need to be seriously questioned, because billions of dollars of wealth have just evaporated. And at the end of the day, someone needs to explain why. Was this all just bad luck, or underneath it all, we need to investigate and find out if there was gross mismanagement, maybe even criminal acts?
Yeah, we should examine that, but on the other hand, we should not go on a witch hunt, because as I told you, like in the case of SVB, the basic cause was that the interest rates went up, and you did not manage it well. But to call it criminal would be, I think, stretching it a bit far. And so mistakes were made, obviously. And in the longer term, this kind of bailout by regulators, that causes something called moral hazard. So now what is moral hazard? So for now, the problem has been contained. But what is moral hazard? That in subsequent rounds or subsequently, players might take more than prudent risk, that if that the returns come to me, but if something goes south, the regulator is there to take the risk on. So where will it cause the moral hazard? In these cases, the shareholders have not got any money. So obviously, this is not a moral hazard for future bank shareholders, but it can be a moral hazard for management. So because both in the case of SVB as well as Credit Suisse, the managers have got their bonuses also before these bailouts.
Exactly. I think you simplified my question, Devina. I'm not saying they should be behind bars, but in any job, if you flub up so badly, if you mess up so badly, you're not going to keep your job. You're going to be punished in whatever industry you are in, at least by, losing your reputation. The fat cats at banks never seem to feel the heat.
Well, in this case, maybe, once all investigations are done, they might have to return the bonuses, but for now, they have got it. So I'm saying this is a moral hazard, A, for the management, B, also for large depositors, because earlier the insurance, let us say in the US, was for people who had up to $250,000 of deposits. There was no insurance for large depositors. And SVB actually had mostly large depositors, because these were startups who raised money and put that money in the bank. So they did not even have to wait a day to withdraw their money, because that bailout happened on the weekend. So that means that's a future moral hazard for any corporate looking to deposit large sums, that I don't have to look at how good or viable the bank is. I just go, let's say, for the highest interest rates or convenience or whatever. And then if there is a problem, the regulator will bail me out. So that's the other part of the moral hazard. In the GFC of 2008-9, the great financial crisis, I think there were also elements of criminality. But in the US, I see the focus is very much on keeping the system going, keeping the confidence, and just making sure nothing shakes the markets. And rather than pursuing and persecuting, so nobody went behind bars for GFC, though I think there was good case to be made, at least for some of them to be there. So which is the other extreme from how India manages it, where we just go on litigating for decades together and not look to make the money whole. Harshad Mehta's case being a case in point, that the money was there to repay all his liabilities, but it's 30 years of cases and no money back to anybody. I'll add something, it's just an interesting tidbit, that after the regulator said that they would guarantee all the deposits of SVB and also of other banks who need it, SVB actually has been marketing this. They are advertising this, saying that give us your deposits. This is the safest place in the world to be because all our deposits are guaranteed. I mean, I'm not making this up. They're actually
wow,
marketing.
the cheek. Imagine the cheek of it.
And Tamanna, HSBC bought SVB's UK arm for one pound, okay? So 6 billion balance sheet, which they valued at £1. And after HSBC bought them, the management paid themselves bonuses of about 20 million pounds the day after. I mean, if this is not criminal, then what is? How can you do that?
Which is exactly my point. I mean, we've started this show to explain to people what's happening. And again, there's nothing to panic. Your money is safe in your banks. Indian banks are super, super, super duper safe. I cannot, underline that more. But it's really, there's something rotten going on. Devina Mehra, it's something rotten going on, and my question is, has it been stemmed? Has this cauterization and bandaging of the global banking system by their respective, central banks and governments been enough? Or is there a deeper treatment that is going to be required, and will we see more symptoms festering?
I mean, fingers crossed, there might be more banks, as Ajay mentioned, who might be in trouble, but I'm sure the regulators, and they've already said that they will backstop any kind of liquidity issue and basically insure the depositors. So US has said it explicitly. And I must say that after US did this, the European regulators and banks were very upset with the US because they had in the past said that this should not be done, and they were like, they did it in a day. So that, I mean, as I said, this might have longer term repercussions in terms of what other risks people take. But that aside, for now, I think, I mean, as far as is known of what the dimensions of the problem are, the regulators can manage if there's nothing else coming out, as I said, because it is not a credit crisis. Though, I mean, there's one thought in my mind which has been bothering me, that the regulators knew they were raising rates at an unprecedented rate, at least unprecedented in the sense of being in anybody's living career memory. And therefore, they would know that that all banks with high investments would be exposed to great price risk, because as to explain to your viewers, as interest rates go up, bond prices go down, bond or any fixed income prices go down, and the longer the tenor of the bond, the more the prices go down. So this should have been a kind of a red flag for regulators, that we are raising rates so rapidly and this can cause problems in banks. So I don't know what kind of regulatory oversight also was there, because this is not like a problem which came out of nowhere that nobody knew about.
Yeah.
It came directly out of the actions of one section of the regulator. So this I would say is also a problem of regulation.